Three, two.
The broadcast is now starting. All attendees are in listen-only mode.
Hi, everybody. Keith Martin. I'm a partner with Norton Rose FULBRIGHT in the Washington office. It's a hard name for me to remember since I spent 34 years at Chadbourne and Park. We merged with Norton Rose on June 30. I'm joined today by Ed Fio, who's president of CORONAL Energy. Ed, I always have to ask how to pronounce that. CORONAL?
You did it correctly. Thank you.
CORONAL. Okay, Energy. Ed, for a long time, was an executive committee member and a co-head of the project finance group at Milbank Tweed, a prominent law firm. Andy Redinger is managing director, group head, utilities, power, and alternative energy at KeyBanc Capital Markets. Rhone Resch, the longtime head of the Solar Energy Industries Association. He left that post last year. He's currently a board member of Sunworks, Inc. And Jigar Shah, who is co-founder of Generate Capital and is well known in the industry as one of the founders of Sun Edison and a big thinker about solar trends. Our topic today is the top 10 industry trends and challenges. Today, we're focused on solar and in particular utility scale solar. I'd like to start with Ed Fio. Ed, give us your list. What do you think are the top trends and challenges?
Thanks, Keith. I guess I'll just name a few and keep it brief, and I'm sure the other folks will come up with even more. Our business is focused principally in the utility market, so that's the world I know. And the things I think I would point to is, one is diversification of the customer base. PERPA, being on the downtrend, voluntary purchases being on the uptrend, and seeing more kind of non-IOU purchasers, including co-ops, CCAs, corporates, and also emergent financial hedge deals. And then there are sort of all the related issues in terms of how the contracts change with the different customers. Second thing I think is an uptick in utility self-procurement. It seems to be growing. Third is continued cost reductions, 16 into 17, and the pretty significant decreases in price, but adding in sort of the uncertainty of the trade case, which I'm sure we'll talk about. Next thing I think would just be the usual regulatory policies having an effect, whether it's the step down in the ITC, coming up over the horizon, the post-PERPA world and how that works, or most significantly the trade case, which has some pretty significant consequences if it goes the wrong direction. I think I would list the incorporation of storage into solar to try to come up with maybe a more useful product, as well as other ancillary services and less commoditization, which definitely is sort of the standard solar situation. And finally, on financing, what I'd say the world is there's a lot of money, and sort of standard kind of middle of the fairway stuff gets, plenty of money. And the fun is where you start to see, new customers, shorter tenors, different credits, financial instruments, and just seeing how the financial world deals, with those. So I'll stop there.
Pretty good list. So, Andy Redinger, what's left?
In no particular order, just, I agree that there's abundant debt and equity, and those costs, the costs of both continue to trend lower. I agree with what Ed said there. I will say small scale utility projects continue to dominate the activity. I'd say, financing and trend we're seeing is financing providers. We're beginning to look at providing credit past the expiration of the PPA. There's a couple things going on there that are interesting in the solar space. The rating agencies, I'll also mention them. The institutional market seems to be what they traditionally have been lagging the bank market. They seem to be roaring up to speed, and I think the rating agencies as well have realized there's a lot of potential refinancing business out of the bank into the institutional market. And we see them becoming more aggressive on how they rate these projects. And then, obviously there's an increase in other challenges, an increase in non-rated off-takers that we are having to find a way to deal with. And I'll stop there. I got several more, but leave some. I hate to go last on this panel.
Rhone Resch, anything to add?
Thanks, Keith. Yeah, I think you guys are hitting some of the major points, but I also really want to emphasize the fact that all of this has the shadow of the 201 trade case over it. And, until we kind of fully flesh that out, a lot of these other issues may not be as important, simply because the trade case could clearly increase the cost of modules in the United States quite significantly. The other piece to that, though, that I do want to point out, and it's not related to the trade case per se, but it's certainly related to the increase that we have seen already this year in pricing, is the China market, where China is going to be almost twice as big as what a lot of people assumed at the beginning of the year, closer to a 45 to 50 gigawatt market, which is putting an upward pressure on pricing globally. And certainly we're feeling that here in the United States, as well as that link to the 201 case and some of the uncertainty. But if I were to step back and say, okay, where do we see utility scale and some of the changes, I would also continue to emphasize new technology that's coming into the marketplace and new opportunities for companies to continue to lower costs. And that's using new designs with higher voltage inverters. You're seeing now optimizers actually be used in utility scale projects. Trackers continue to have a much larger percentage of the utility scale market. You now have technology to address PID issues around modules, which is helpful for some of the existing assets. And then, as both people mentioned, storage is critical with respect to the new technology piece. And then finally, I think, in addition to what everybody else has talked about with the resources coming in, there is a fairly positive trend of companies picking up and purchasing existing assets. We're seeing that across the board with not just NRG selling their assets and Canadian, but many other companies as well. And we're finding a decent resale market there. I think that bodes well in the long run for utility scale development. The key, of course, is just to make sure the PPAs that we're signing today can be met with where module prices are headed in the next 6 months.
Ron, back up one step. You said there are new technologies to address. Did I hear PIB, and what is that?
PID, it's actually an issue that we're finding increasingly problematic for some of the existing assets and some of the lower quality modules, but frankly, it's an issue that affects almost all modules, crystalline silicon. It's called potential induced degradation, and it is a process where you see a rapid degradation of modules in the field. This is some kind of naturally occurring elements of voltage, heat and humidity, and just kind of general operating conditions. But it can have a very severe decrease in the actual output of modules. The good news is we have new technologies that you can put in line for systems that haven't had a severe PID development, and it will reverse it. So these are the kinds of new technologies that are coming into play that are addressing some of the concerns we had just a couple of years ago about existing assets and some of the lower quality modules that may have been installed for some of the utility stuff.
Okay, fair enough. Jigar Shah, is there anything left?
I don't know. It feels like I have been, all the things on my list have been taken. The one thing I would say broadly is that I do think that the utility scale solar projects in general have a value problem. So in general, I think that, bids have been quite aggressive. And with the upward pressure in module prices and other things, instead of actually figuring out how to cut costs, what we've been finding has worked for us is figuring out how to increase value in the assets. So that's adding battery storage to the deals where we've been funding both the solar and the battery storage. We've also found that many folks have opted to take advantage of this sort of IRS loophole around 25D, where they actually sell community solar projects directly to homeowners at much higher prices than infrastructure folks are willing to pay for them, and other sort of value creation activities. So we've been pretty focused on increasing the value of existing utility scale projects as opposed to cutting costs.
Let me dig in here and ask some questions. And audience, if you have questions of your own, you can type them in. There's a question box to the right of your screen, I believe. Type it in. We'll take them as we go along. So let me start with the trade case, Suniva, and let me just poll. How many people think tariffs will be the outcome? Rhone?
This is Rhone. I think you're going to see both tariffs and quotas put in place, different quotas for different countries, but I think it's going to be the combination of the two.
Okay. Andy Redinger, what do you think?
Yeah, I think tariffs will be some tariff will be implemented.
Jigar?
Well, I still think we have an ability to avoid the tariffs if we, all work hard on, paying for advertising on Fox and Friends and Morning Joe. It's crazy that it's come to that. The other thing, but I do think that, it's likely that tariffs will be applied, and I think it'll be a big win for bifacial payments.
And Theo, you're the one actually having to pay tariffs if they're imposed. What do you think?
Yeah, Keith, I think this is one of these questions that I hate to answer because probably exactly, yeah, because there is a good argument to be made about the circumstances of the petitioners and sort of why they invited catastrophe upon themselves, but also you have to look at the political climate in which we live, and plan for what may be the outcome of tariffs being imposed.
It's interesting, at recent industry conferences, if you poll audiences, very few people think tariffs will be imposed. It may just be a developer optimism. And sticking with you, how do you see the threat of tariffs playing out currently in the market? You mentioned panel prices going up, I think. What else? How is it playing out in deals?
So I guess there's two things that I would mention. I mean, there's been the near-term effect on the panel market, which the effect of it was essentially on all non-U.S. or non-crystalline panels that were available and arguably had a case for not being subject to tariffs sold out, and the prices got bid up pretty dramatically as people looked to cover their 2018 projects. And then the knock-on effect was for solar, as having a technology not subject to the case, they sold out for 18. So you have a real constraint in the market in terms of availability of panels for 18, pending the outcome of the case. The second impact is, this is a business. In some respects, it's a little bit crazy because as a developer, you're going to customers and saying, I can deliver a product to you in 2019 or 20 at this cost based on a bunch of assumptions, one of which is, what's going to cost us to get on the ground. And so in those circumstances, you have to have strategies to, mitigate, okay, how much pain can I take? At what point does this basically not make any sense? And at least at this point, you don't really, at least that we've seen, have customers who are, at least in the utility market, we've seen it in the commercial market, some willing to bear the risk of panel cost increases as a result of the case.
So anyone else on Suniva, how are you seeing risk allocated of potential tariffs?
Well,
Keith, this is Andy.
Yeah, go for it, Andy.
I was just going to say, we continue to, I think banks will have a hard time, taking any of that risk on. So we're, in the one deal we've seen where that was an issue, we've, structured around it and put all that pricing risk back to the developer. But I'd be surprised if banks end up taking that risk on.
Okay. Someone else is going to speak.
Yeah, this is Jigar. I mean, for better or for worse, it's been, good for our business, right? Because I think that, at Generate, we're willing to take those risks. We have our own module supply. And so, we've been able to clear deals at, 100 basis points higher than people thought they were going to get for their cost of capital. And then just unitranche the deal where we provide construction and perm financing. And so it's become a way for us to clear the market. But, I get the fact that it's not great for the industry.
Okay. Rhone Resch, you mentioned that the China market may be a lot larger than expected, the market being demand for solar panels. That's accounting for additional upward pressure on prices. Are we in that cycle of the panel manufacturers, where we now have shortages and the business model that some solar developers pursued in the past of signing contracts where they don't have to start delivering power for a few years at very low prices in the hope they figure they can, by the time they have to start delivering, panel prices will have come down enough that they can honor those contracts. Are we now in a period where that business model doesn't work?
Absolutely, Keith. We've already seen, since the case was introduced, module prices increased by 30, 40% or more. And so, the 3-year trend that we had seen of rapidly declining prices for modules allowed some of those aggressive pricing for PPAs. Now you're seeing just the opposite, and you're seeing a number of cancellations across the country. The China model is really year to year. It's not going to be sustained at those kinds of crazy levels, but certainly for this year, most of the companies have decided to keep their available modules in country. They're not going to run the risk of imports to the United States. They get a better pricing there, and also I think in the long run, they're finding that the political uncertainty associated with the U.S. market is frustrating. And so all of the sales guys you talk to in the United States, they're finding it frustrating that they can't even get modules. And I think that's going to be the case for a long time. And it's important when we look at the 201 that this is a minimum 4 years. Now, there's lots of different scenarios that could play out, including it could be overturned by the WTO. But Geneva could also ask for an additional 4 years. So it could be as long as 8 years if you have some type of tariff and quote structure in place. So this may be a situation we're going to have to live with for a fairly long period of time. And it's going to be one in which I think the market responds in creative and different ways. One of which may be Chinese companies building manufacturing facilities in those countries that are going to be low tariff or no tariff. It could be the United States, it could be Canada, it could be Mexico, a variety of different scenarios. And I think that's where a lot of the resources that the Chinese companies are going to be pulling in over the next 6 months are going to be headed towards greater expansion. It may not be with Geneva and Solar World, but it will be if these are put in place and they are stern enough, a clear market signal to build manufacturing in the U.S. And that may help us in the long run.
Okay. Ed Fio, you mentioned as your number one trend, diversification of the customer base. Is another way of saying that it's getting harder and harder to find power contracts?
Well, that's a really negative point of view, Keith. I think it's more. It's a combination of. I think I'd call it the maturation of the business, and also costs. Again, putting aside trade case effects, costs coming down, where you're really seeing solar being a viable alternative to different types of customers. So we had like the huge wave of utility scale solar that was really principally driven by either PURPA or by big RPS mandates. And now you see a lot smaller entities, not the Southern California Edisons of the world, but really small utilities looking to do solar because it's a good economic decision, as well as a good environmental decision. And, they're purchasing, they're not buying 100 megawatt projects. So, that's where you start to see, the 10s and the 20s kind of dominating the landscape as opposed to multi-100 megawatt projects. Corporates kind of fall in the same boat, although, some of them are able to go larger. And then finally, we're also seeing, again, putting aside the effect of the trade case, I guess I'd say the incipient market for financial hedges on solar, which has been something you've seen in wind for a while and certainly been in the gas-fired market for a long time. But that tells you something about where the cost curve for solar has gotten to. And, if it continued on the trend, you'd see more of it. If the trade case goes in the wrong direction, a lot of this stuff kind of gets put on hold until prices settle back down.
The falling electricity prices are creating opportunities then. As far as development of financial instruments for projects in organized markets, are you seeing solar revenue puts, other forms of hedges employed already in solar? Anybody?
Well, there's certainly a lot of deals that are getting those types of things done. So deals that we've done in New Jersey, for instance, there are a lot of deals that were done there with, sort of crazy SREC revenue sort of expectations where the power was sold merchant. We've been able to go to, Morgan Stanley and get sort of, a 10-year strip locked in. And then, for us, the revenue is not that important because it's at 3.8 cents a kilowatt hour or something. But but for us, not being in the merchant marketplace is important.
Okay. Ed Feo mentioned in his group of policy changes, not only the Suniva case, but also tax reform. Andy Redinger, what effect is the threat of tax reform having on the market?
In the solar space, not as much as I think people originally thought. Is obviously it's an ITC tax product, and it just doesn't have that much of effect on solar if there was a change in tax rates through the model. And it's easily handled through a little bit of structuring, so it really hasn't affected the market at all in regards to deals getting done.
I read that the wind market was down in the first half of the year by 70%. Solar flat, $3.66 billion in tax equity this year compared to $3.7 billion last year, which seems to bear out what Andy just said. Does anyone else see an effect of potential tax reform on the market currently?
This is Rhone. Keith, I don't. I don't think the ITC is going to be a target in tax reform. We already cut the deal so that we have a declining rate over a number of years. It was a deal that was intended to get rid of the tax credit, and any type of tax reform is going to be instituted over a number of years anyway. So I think that ITC is in good shape. That you could lose the permanent 10%, but I don't think anybody's factoring that into any of those projects until out to 2023 or beyond. And we still need a clear definition on commenced construction. So I think the ITC is in very good shape. I don't think it's going to be a threat. And certainly the Republican supporters that we have on the Ways and Means and Finance Committee are going to make sure that the ITC is protected, because they were the primary architects for getting this deal done a couple of years ago. So
okay.
Andy Redinger, you mentioned. Go ahead.
Oh, sorry. I was going to say. I mean, I think that's right. I mean, but the reality of doing deals in 2017 in tax equity is, well, I think people kind of got their heads around a 30% ITC. You're definitely structuring around the potential change in tax rate or depreciation, right? So, so for developers, I mean, as far as I can tell, that the risk is basically being passed along by the investors. So we're essentially either pricing in or we're covering that risk for the investor today, right?
Some more questions. That was Ed Feo. And by the way, if you've patched in late, Ed Feo Coronal, Jigar Shah with Regenerate Capital, Andy Redinger with KeyBanc, and Rhone Resch, formerly head of the Solar Energy Industries Association. We're talking about trends and challenges in the utility scale solar market. CCAs, nobody mentioned community choice aggregators, although Ed, you mentioned is a big trend, the proliferation in types of off-takers. Do you see a rush by these CCAs to sign power contracts? Or are they really an opportunity?
Yeah, I don't know that I call it a rush, but they're definitely signing contracts, and they present. The good news is that's another customer class. The interesting news is to really parse through, what their credit is like, and B, what are the circumstances, where they can kind of keep their arms around their customers. So I think those, if they haven't hit the market, already, they'll certainly be in the financial market, and banks will be dealing with how to evaluate that credit and structure.
The California Public Utilities Commission estimated that as many as 85% of the retail load in California would flee the investor-owned utilities by the mid-2020s, many of them to CCAs. How will the IOUs, investor-owned utilities, are trying to charge exit fees for people who leave the grid? How will exit fees play into financeability of projects, if at all?
Well, they're two steps removed, right? The CCAs would be the ones that would be sort of subject to the regulation. They're then doing a procurement for the solar, right? So they're two steps removed. I mean, the other challenge, which I think Ed said, but just I can say, more forcefully, is that the CCAs, have not been around that long, and so figuring out their credit profile is actually quite difficult.
Okay, that was Jigar Shah. Andy Redinger, you mentioned lots of liquidity, debt, tax equity, the cost of money is coming down. I think you've also mentioned in the past there's a wall of money looking for contracted assets. What are current discount rates, anyone, for buying operating assets? Any feel for it?
Yeah, I mean, it's clearly in the solar space, it's, I would say, sub 9% kind of levered equity returns, and in some cases it's even much lower than that. There's a handful of really aggressive money out there that we've all seen, but the vast majority is, I would say, in that 8 to 9% levered area. And then on CCAs, I think there is a lot of capital out there, and I have no doubt that they'll find financing, is just at what cost. There's a lot of capital out there, and I think it's just a matter of getting your arms around the credit profile and how much that costs. It may be cost prohibitive once you get into the details around the CCAs and understand that customers can leave whenever they want or after a year. I mean, I think there is capital for it, but it may be cost prohibitive.
Andy, Ted Brandt from Marathon Capital said he thought discount rates for utility scale solar were around 6.5%, 6.5 to 7. He said that earlier in the summer. You now said 8 to 9% levered. Do those two equate, or you just think they're higher?
No, I think Ted's not wrong. I think, as I said, caveated by, there is a handful of really cheap capital out there, but it doesn't represent the majority of where people's capital costs are. My commentary was more around where the middle of that bell curve is. Ted's comments aren't inaccurate. It's just he's out on one end of that bell curve.
Okay. Ted's trying to find the folks with 6.5% money.
Say that again, Jigar.
That's trying to sell the assets he represents to 6.5% money.
Okay.
Right. I was going to add to that, Keith, that it's it's always, IRO is always amusing, right? Because tell me what the assumptions are, and you'll find that two numbers that seem wildly different are actually not too different at all. As Andy says, both numbers are right. To me, what's been interesting in utility scale solar is how much the valuation is now being driven by an ever extending life of asset. You know, when I mean, literally just a handful of years ago, you'd be doing deals on a 20-year life, you know, and sort of that's the financial horizon. And now it's out to 35, even 40 years people are bidding on. And so a lot of value is created by what your assumptions are about those out years. And what that all means, I mean, in some respects, that's good because it shows that people are thinking that these assets are actually going to be around for a long period of time. But it also means that, you know, going back to a point I think Rhone mentioned, is that the ability to enhance the performance of that asset over time and over its life is going to be huge. You know, this is not the world of just do your project, finance it, and throw it in a drawer and forget about it. It's actually, you got to drive value through, you know, 4 decades.
Well, I mean, to be clear on my side, I certainly think that it's a bubble, and that's what it's showing. Like, I can't imagine utility scale assets in 20 years are going to be worth the same PPA price that they've currently got. I think we're going to have an oversupply of power during the middle of the day, and you're going to have to pay for battery storage to be added just to shift the power curve.
Jigar, you think we'll have an oversupply of power even though people may have switched to electric cars?
Oh, for sure. I mean, you can have both, right? If we're adding 15 gigawatts of solar a year to the grid, which I think we all expect to at least do that, and then if we have growth, we do more, then over 10 years, you're adding 150 gigawatts of power, and you're not doing it evenly across all 50 states. You're doing it in mostly 20 states. It's entirely possible that during the day, you've got 50 to 70% of the power coming from solar, which means that you have excess power, and wholesale market prices already depressed around the country. Like, I think you're going to see them depressed further.
Okay. Desperate lenders. Andy Redinger, earlier in the year, lenders were complaining there weren't enough deals and there was downward pressure on interest rates. Seems still to be the case, although we've heard lately that some lenders think the deal flow is starting to pick up. What are you seeing in the market?
I don't know if I'd say the deal flow is starting to pick up. It seems to be where it's been all year long, kind of flat. But I will tell you that, margins, there's so much competition now versus just 3 or 4 years ago in the space. Margins continue to be compressed just because, one, the rest of the economy, I don't think there's as much loan growth as people or maybe the press portrays. I don't know how good the economy's doing because a lot of banks' loans growth is being pressured, which then helps move those margins down. And we find a lot of people chasing these solar transactions now. And, I don't think margins have been any tighter than they are currently since we started in the business.
Okay. Ed Fio, it seems like, to what do you attribute as a developer the dearth of projects seeking financing this year?
Well, I think if you just, you look at the numbers, 17 or 16 rather was a pretty robust year. I think mainly because of a confluence of timing around when procurements occurred, plus was it 15, we were uncertain about what was going to happen, with the ITC. And so just a lot of things got pulled forward. So that was a pretty robust year. And then this year, I don't know, I'm thinking of like Green Tech Media's numbers, it shows that as maybe, installations, I want to say half to 2/3 of the year before. So it doesn't surprise me that from the perspective of people looking to invest or finance, it looks like there's not a lot of assets compared to maybe what they saw 12 months ago. It's clear, it's also clear on the equity side that, assets have been bid up. And so if you're in the development business, what that's telling you is there's not a lot of, it's a supply demand imbalance, because the stuff that you have is definitely getting bid up by people who would love to, put money into them.
And that should bring more developers back in, correct? When do you see the cycle turning around?
I think, again, putting aside the trade case, which I agree with Rhone is, it's the wild card, but, and that's maybe like, assuming away the whole issue. But if you could put that on the sideline for a minute, I think you'd see 18 is going to be a so-so year, and then you're going to see, really pretty significant volumes in 19 and 20 to try to, take advantage of the higher ITC, and then it'll probably tail off, again in 21. And then the question is, what's the product that you have to offer, and at some point there, the combination of or the interaction of solar and storage really should be firing pretty hard in the 2021 time frame.
Okay.
Then you can continue to ride that curve out for the rest of the decade.
Andy Redinger, coming back to you, you mentioned abundant debt and equity. The costs are continuing to trend lower. How much lower? Where do you put interest rates right now? Where do you put tax equity?
I can certainly talk about margin. I mean, margins for, tier one players are in that, 162.5 to 175 area. And, we have seen a few deals getting done in that, operating projects with some history getting done in that L150 area. Tax equity, Keith, I don't think, I've always said this, it hasn't changed for years. We're seeing in that, 8% area yield wise. But I have not seen a change in that. It's kind of what I've seen forever. So maybe someone else on the panel can talk about that, but hasn't changed really from where I sit.
Jigar, you're in the tax equity market. Where do you think yields are?
Yeah, I don't think the pricing has changed in the tax equity market. Most of the tier one guys are sort of between 1.25 times the tax credit to 1.3 times the tax credit in terms of their advance rates. But they're definitely looking for deals. I mean, I'm getting way more calls. Earlier in the year, they were like, we're already booked up. And later in the year now, they're saying, hey, wait a second. We actually had a lot of projects fall through. We need more capacity to fill our numbers for the year. So I don't think the pricing is changing, but the availability of tax appetite is pretty plentiful right now.
Okay. Andy Redinger, you said that people are looking at providing credit past the term of the PPA. A couple interesting things are going on there. What are those interesting things?
Yeah, it's just a sense of how aggressive and how many people are out there looking to put money to work because they need loan growth. So, yeah, we and others we know are starting to look at, maybe giving credit for a couple years past the expiration of the PPA. What we would do is then sweep starting, a couple years before the expiration of the PPA. So the loan in effect would be paid off within the period of the PPA, but it moves kind of some of the back end money up front, helps the developer get more money up front. I think that's the interim step. Eventually, I think where I see it going is we just give them full credit for the 2 years past or 3 years past the end of the PPA with no sweeps at the end of the loan. But it's just a function of, again, the aggressiveness of the marketplace. And there's this wave of refinancing we see coming, really starting, late this year into next year and the year after of, those deals that were done in 9, 10, and 11. And these are deals in which a lot of the tax equity is rolling off. And we see good competition between institutional investors because the tax equity's out, the institutional market as well as the bank market. So it's now you have, traditionally it was just banks fighting for it, but in older deals where they're rolling off after the tax equity, you now have a whole new group of investors coming in buying for those assets as well, which to me screams for, more competition means lower pricing.
Okay.
More aggressive structure.
Go ahead, Jigar.
Well, I also think that the reset of the market is really valuable, right? This is what Andy's describing, and I don't mean to put words in your mouth, Andy, is that the market has found the new ultimate owners of the assets, right? Which matters because for a few years in there we thought the yieldcos were going to be the ultimate owners. They've now blown up such that First Solar and SunPower don't actually believe that they're the lowest cost of capital, which is why they're trying to sell out. And you're now finding pension funds, insurance companies, and others who have become the lowest cost of permanent equity and debt capital for the assets, right? And so we're trying to get them to do the price discovery such that everyone else's price of capital, of course, is higher than that because they need to make their fees.
Yeah, I agree with Jigar. The player that still needs to, I think, get up to speed still are the rating agencies, and they have come a long way from just where they were last year. But they still need to, because a lot of those guys need ratings, and the agencies are getting better at rating these, but they still got a ways to go, I think, in regards to the haircuts they put on some of these deals and things like that. But they're moving in the right direction.
Does anyone see consolidation of sponsors going on? Tom Buchenbach said earlier in the summer he thought we'd be down to 5 utility scale solar sponsors within some reasonably short time period.
I doubt it.
I don't think 5 is necessarily the right number, but yeah, there's consolidation going on, and it's going to continue.
Yeah, the consolidation is definitely going on, but I think that there's an expansion on the other side, right? I mean, when you look at like what the first wind guys were able to do in terms of getting development capital out of New Zealand, and ultimately they're basically going to become the new sponsor. They're going to roll that money into that. So I think you're seeing, I mean, folks like TIA CREF has backed 4 new development platforms. So I completely agree that the traditional players are consolidating into 5, but then there's 15 new players that are being funded that have sort of unique approaches on the development side.
Okay. Ed Fio, you mentioned that one of the interesting things about the diversification of the customer base is how the contracts change with different customers. Say a little about that.
Sure. Well, I think probably 2 things. One is it's the tenor of the contract. Corporate market is, generally a shorter tenor. They're looking for a shorter tenor deal versus, the 20 or 25 years that you'd say is middle of the fairway for utilities. Although, we also have 15-year utility deals and 10-year utility deals. So, maybe that's a distinction without a difference. And then I think the other place we really see a difference is driven, maybe it started in the corporate market, but we see it, more so now on the utility side as well, is essentially where's your point of interconnect, and who's taking essentially responsibility for not just cost of delivery, but any basis risk issue between where the plant is and where the customer actually gets his power.
Okay, we've come to the last minute. Let me sum up for people who've been listening what we've heard today in terms of new trends and challenges. We've had Ed Fio started off, and he said on his trend list was diversification of the customer base. PURPA, which is a 1978 statute that has been used in the past to secure power contracts with utilities, its use is phasing out. There are more co-ops, financial hedges. You've just heard him describe how contracts change with different types of customers. Another thing on his list was the uptick in utility self-procurement. Another one was continued cost reductions. We've seen a pretty significant decrease in solar panel prices, although that's now starting, the rate of decrease is moderating, if not reversing. He also had on his list the policy changes that are potentially in the offering. The Geneva trade case, there may be tariffs. We heard from our panel that I think the majority who expressed views are fearful that there will be tariffs imposed. No one would like to see them. And also just the potential changes in the tax reform area. We heard here that they're not having much of an effect. Tax reform is not having much of an effect this year. We did hear that tariffs, though, the potential for tariffs is affecting the market, that the types of panels that will be affected by tariffs have largely sold out already. It's hard to get them. We heard from Ed Fio and on his trend list, incorporating storage into solar is another trend. It helps people come up with a more useful product, injects revenue through ability to provide ancillary services. We heard that there's just a lot of money available, that for the standard middle of the fairway stuff, there is plenty of money, particularly for the tier 1 developers. The new customers, the shorter tenors, potentially new financial instruments, new types of off-takers. These are all posing challenges for lenders and tax equity investors. But with the dearth of deals, they are seemingly figuring out some way to deal with each of them. Andy Redinger on his list, abundant debt and equity. The costs continue to trend lower. Small projects dominate. We heard there have been 3.66 billion in tax equity in solar in the first half of this year, about the same as last year. Andy explained how lenders, in particular, are looking at providing credit past the term of the PPA. The institutional market is roaring up to speed. It's particularly a place where deals that were initially financed in the bank market might refinance with institutional lenders. Rating agencies, Andy Redinger said, are becoming more aggressive in how they rate these projects. We're also seeing an increase in non-rated or unrated off-takers. Community choice aggregators in California are an example of that. Andy said the market is having to deal with them, and we'll figure out a way to do so. Rhone Resch pointed to the trade case as probably the biggest effect on the market this year. The increase in the cost of modules could be significant if tariffs are imposed. He thinks there'll be a mix of tariffs and quotas with individual countries. He pointed out that any tariffs would remain in place for 4 years, although they phase out over that 4-year period unless set aside during that time period by a WTO, World Trade Organization, complaint. Rhone pointed out that the China market demand for solar panels in China is very hot, and that is causing panel prices to firm up, maybe even trend up. He thinks that market will be much bigger than people thought earlier in the year. He also pointed out that new technology is coming to market, particularly to deal with the degradation in solar panels, sudden degradation. And he said there's a fairly positive trend of companies picking up and purchasing existing assets. Jigar Shah said that utility-scale solar projects have a value problem. He looks in deals where operating assets are purchased to try to enhance the value. Bids have been quite aggressive in buying those sorts of assets. Adding storage helps, he said. He also pointed out that many people have opted to take advantage of what he called an IRS loophole around Section 25D of the tax code. That's the residential solar credit, to sell panels, presumably in community solar arrays, directly to customers, individuals. So that's our webinar. I'd like to thank our participants here, Ed Fio, who's president of Coronal Energy, Andy Redinger, who's managing director, group head, utilities, power, and alternative energy with KeyBanc Capital Markets, Rhone Resch, longtime head of the Solar Energy Industries Association and currently a board member with Sunworks, and Jigar Shah, one of the founders of SunEdison, currently co-founder of Generate Capital. I'm Keith Martin with Norton Rose Fulbright in Washington. Thanks, everyone, for patching in.
All right.